Most people will never know what $107 million feels like, but almost everyone knows what $1,500 feels like at 23:17 on a Tuesday night, lying on a secondhand mattress, watching a number that does not move. This is the story of both, and the distance between them is not luck, it is not talent, it is not timing. It is a series of decisions that almost nobody talks about made at every level. From the first screenshot of a zero balance to a board meeting where five people control enough capital to reshape an economy. By the end of this, you will understand exactly what changes at each level, not the numbers, the thinking. Because the thinking is what moves the numbers. Watch carefully, because this story starts exactly where you are right now. Your balance is $1,500, not your savings, your balance. You check it at 23:17, lying on a mattress you bought secondhand. You check it again at 23:18. The number does not change. You have $29,000 in student loans, $3,800 on a credit card, and a direct deposit hitting Friday that is already spent. You are 25 years old. You are not behind. You tell yourself you are not behind, but every grocery run is a calculation. You put the olive oil back. You buy the store brand. You split a streaming password with someone you do not particularly like anymore because canceling feels like losing ground. This is what zero feels like. Not dramatic, not cinematic, just a low, constant hum of arithmetic running underneath everything you do. You watch your bank app more than your messages. You know your account number by heart. You move $200 to savings and move it back 3 days later. At this level, money is not a tool. Money is the air. Either you have enough or you are already suffocating, and you cannot always tell which one it is. The first rule: at zero, your relationship with money is entirely emotional, and emotional decisions compound in the wrong direction. You get a raise, not a big one, $5,500 a year before tax. It lands as $340 extra per month. You feel wealthy for approximately one afternoon, then the car needs $800 in repairs. You learn that expenses expand to meet whatever space you make for them. You pay off the smallest card, $1,100. You screenshot the zero balance. You send it to nobody because nobody would understand why this screenshot means what it means to you. But it means everything. Because for the first time, a number moved in the right direction because of a decision you made. That is the beginning. You cross $11,000 in savings for the first time. You are 28. You have never had five figures before, not once. You check the balance constantly for the first week, not out of anxiety this time, out of disbelief. You do not do anything with it. You just let it sit there. The psychological weight of $11,000 when you have never had it is disproportionate to the number itself. You feel like you have crossed into a different category of person. You have not, but you feel it. You start reading, not motivation, not self-help, actual books about how money moves. You learn what an index fund is. You open a brokerage account and stare at it for 3 weeks before you put anything in. You invest $1,400. The market dips the next day. You almost pull it out. You do not. This is the moment you decide whether fear runs your decisions or you do. The shift. You stop thinking about money as safety and start thinking about money as information. You are making $74,000 a year. You have $46,000 saved. You have a retirement account you are actually contributing to. You feel, by most measures, fine, stable. You are doing what you were told to do. Max the contributions. Build an emergency fund. Avoid lifestyle inflation. You are doing all of it. And then you sit down and run the numbers honestly, all the way out. You type the projections into a spreadsheet at midnight, and you stare at what 35 years of disciplined saving at your current income looks like, and something shifts in your chest. Because the number at the end is not what you thought it was. It is fine. It is enough. It is not what you want. This is the competence plateau. You are good at surviving. You are not yet good at building. The second rule: salary is a ceiling dressed up as a floor. The moment you see it clearly, you cannot unsee it. You start a side project. You do not call it a business. It is just a thing you do on weekends that makes $400 a month, then 800, then 1,000, 600. You reinvest everything back into it for 16 months. You eat the same lunches. You do not upgrade anything. Your net worth crosses $91,000, then $124,000. You start feeling the gap between where you are and where a salary alone would have taken you. The gap is where the leverage lives. Your investments return $3,400 in a single year without you doing anything. You have had months where your side income was higher than your paycheck. You know what an asset is now, not theoretically, physically, something you built or bought that earns while you sleep. Your relationship with time changes. Every hour spent on something that does not compound is an hour the machine is not running. You cross $168,000 in net worth. You are 34. You have a rental property with $41,000 in equity, a brokerage account at $57,000, a business generating $5,800 a month. You still drive the same car. You do not tell people about any of this. Talking about money at this level makes people strange, either envious or dismissive. Neither is useful. You start saying no to things that used to be automatic yeses. A destination wedding you cannot afford without liquidating something. A group holiday where everyone splits cost equally and you would be subsidizing three people. A business opportunity pitched by a friend who does not understand cash flow. No, no, no. You feel the friction in the relationships. You feel it, and you stay quiet, and you say no anyway. The shift. You stop spending money to maintain relationships and start protecting capital to build options. At $340,000, your money is starting to have a personality. It has preferences. It wants to go certain places and resists others. You have had one investment return $19,000 in 8 months. You have had one lose $8,600. You do not panic about the loss because you understand now that this is the cost of being in the game. You do not pull back. You reposition. The third rule: below $500,000, you are still buying assets. Above it, assets start buying each other. You can feel it the way you feel a room before you walk into it. $670,000, $810,000. You have restructured the business twice, brought on a partner, exited one investment, and rolled the proceeds into something bigger. You are 38. Your net worth is $1,050,000. You stop sleeping as well as you used to, not from stress, from intensity. You are running scenarios in the shower. You are sending emails at 05:30 inches the morning to people in different time zones. You turn down a job offer that would have paid $195,000 a year. Your parents do not understand. You tell them it did not feel right. That is partially true. Then it happens. A Tuesday. Nothing ceremonial about it. Your account updates and the number is $1.1 million. You sit with it for a moment. You thought you would feel different. There is a quiet satisfaction, and then almost immediately it is not enough. Not in a frantic way. In a clear, practical way, $1.1 million at a 4% return is $44,000 a year. That is not freedom. That is a starting point. The shift. The milestone was never the destination. It was the proof of concept. At $2.6 million, money stops being a source of anxiety entirely. For the first time in your adult life, it is simply a resource. The way time is a resource. The way attention is a resource. You do not think about your checking balance. You think about allocation. Where is the capital positioned? What is its return profile? What are you not seeing? Your business does $4.6 million in revenue. You own two rental properties with a combined equity position of $340,000. Your portfolio is at $1.8 million. You are wealthy in the way that means you have time, actual time. You take a 4-week trip. You do not check email for 6 days of it. This is the thing people cannot buy at lower levels. Not the trip, the 6 days. The fourth rule: wealth is not what you accumulate. It is what you no longer have to do. At $5.7 million, the game changes texture. It is no longer about building. It is about positioning. You are moving capital now, not working for it. You are in a deal that will return $750,000 in 18 months. You are in another that might return nothing. You are in both anyway because one de-risks the other. You start meeting people who are at $20 million, $50 million. You study them the way you studied the $11,000 mark from zero. You watch how they think, not what they own, how they think. The patience is longer. They are not trying to win each hand. They are trying to stay in the game longer than everyone else at the table. At $16 million, you walk into rooms you used to only read about. A meeting with a family office managing $550 million who wants to co-invest alongside you. You are at the table not because you were invited as a courtesy, but because your capital and your pattern recognition are genuinely useful. The fifth rule: at $10 million, your reputation becomes a financial instrument. It earns returns independent of your decisions. Your net worth crosses $34 million. You are 56. You have structures in place that will outlive you, a trust that protects the assets, a foundation that functions partly as access. You have stopped pretending about most things. Pretending costs energy, and energy is the only currency that does not compound. At $91 million, the isolation is not loneliness. It is a different problem. Your closest relationships are with people who operate at the same altitude, not by design, by natural selection of conversation. You give more than you ever have, not for reputation. You give because at this level, money has stopped being a measure of anything meaningful about you. And giving is one of the remaining things that still feels like a decision. The sixth rule: above $50 million, money stops measuring your worth. It starts measuring your reach. You are 63. Your net worth is $107 million. The exact figure is known to four people. You have not worked a conventional day in 11 years. You have not stopped working. You think in cycles now, not quarters, not years, demographic cycles, infrastructure cycles, credit cycles. You position ahead of them the way a sailor reads weather 3 days out. There is a board meeting. 5 people in a room with enough combined capital to reshape a mid-sized economy. You speak for 3 minutes. You ask 3 questions. The room moves around those questions. You leave before the lunch is served. And somewhere in this city right now, there is a 25-year-old opening a banking app for the first time. The balance is $1,500. Standing in line at a grocery store doing the math, putting the good coffee back, getting the store brand, thinking this is a story about money, thinking if you just make more of it, something will resolve. You do not know yet what has to resolve. You do not know what it will cost. Not in dollars, in distance, in the gap that opens between who you are at the beginning and who you have to become to reach the end. The machine does not ask if you are ready. It opens every morning, and it takes whoever shows up, and whoever shows up consistently, patiently, without flinching. They compound. The money compounds, and so does everything else. The balance is $1,500. It always starts there. It always will.